Okay. All right. All right. We're back. We're back to the main room. And thank you again for your time tonight to join our meetup. This is Multifamily and More KC chapter. And we have very special guests tonight. We have two experts in the field with practical knowledge and skill set and real world experience. Hey, Joe, can you introduce two of our guests?
Absolutely. Excited to introduce these guys. First is Robert Musso. And guys, if I mispronounce your name, please smack me virtually. Robert's managing partner of Tucson. Is it Tucson Properties?
Yes, it is.
And is responsible for cultivating relationships with investors, lenders, real estate professionals, community officials, while identifying new acquisitions within their targeted markets, alongside establishing capital improvement programs for each asset. Robert was employed in the hotel and hospitality industry for 17 years, managing the very high-end corporate accounts within five-star luxury hotels and resorts in the US, Canada, Bermuda, Europe, where luxury service design was daily language. Today, as an entrepreneur with 20 years of real estate experience, he successfully acquired and managed multifamily apartment communities, residential properties, condos, vacation homes, commercial real estate as a KP, GP, and LP, all in different hybrid roles. So a vast experience in real estate. His other passions are his two sons, family, and he loves cooking and traveling and sports. So everybody welcome Robert.
Thanks for having me. I appreciate it.
Yeah. And I got one more. Gaspare Urso. Gaspare, did I pronounce that correctly?
Close. Gaspar, like the ghost? What did you?
Gaspare. Okay. Apologize for that.
No worries, no worries. I get it all the time.
He's a founder and CEO of Senate Syndications and has transactional experience in raising capital as well as finding off-market investments for his team. There were 15 years in retail and multifamily real estate. He has expanded his reach from New York and New Jersey to the Midwest and now Pennsylvania. He's proud to call New York Stock Exchange home for over 20 years. His distinction and reputation are well regarded among the Wall Street community from the beginning as a squad to specialist of Fortune 500 and Dow stocks. So welcome our two guest guys, and super excited to have you guys.
Thank you for having us.
Welcome everyone. So today we want to talk about stocks versus multifamily real estate. And we all know this is heavyweight fight and everyone will have a different opinion. As we all know, it's all about your personal goals and needs, both short-term and long-term. So what may make sense for myself and yourself could certainly be fairly different for others. And there are many angles and options for alternate investments. So we're here to guide you, perhaps even slightly debate what may be right for you, presenting facts and pros and cons. And as I said, we have two experts. Both are multifamily investors now, but Gaspare from New York Stock Exchange, 20 years experience, and Robert Musso also as a multifamily investor who also invests in stocks. And now today they're going to talk about pros and cons of both sides. All right, so let's go with multifamily. Go first, Robert.
Well, thank you very much for the intro and for the invite on this. I will say that Gaspare is also a very close friend of mine. We go back 20 years. Our wives are friends since they were young girls. So, and our kids are friends now. So he's a friend, but also an expert in his perspective field. And we're involved in real estate deals together as well. So I really think he's an incredible expert on this panel tonight. So I'm not in Wall Street, hence the suit and tie missing, but I did leave corporate America after 18 years because of the real estate world that we're in today. And if it wasn't for multifamily real estate, I would probably still be wearing my suit and tie and working in corporate America. So I invest in stocks. I invest in multifamily real estate. I'm well diversified within both areas. So it's kind of tough to knock the stock market, in my opinion, as much as I'd want to in a heavyweight fight like this. But I will speak about some of the pros of real estate that have helped me. And I think what's important is that what's right for me might not be right for you. What's right for you might not be right for me. And that's the beauty. You could really pick and choose investments on both sides of the fence. And, I think a lot short term and long term. So I'm making decisions short term and long term with everything in the stock market and within real estate as well. Hence why I'm invested in mutual funds, stocks, and I'm an LP, KP, GP on many deals as well. But to keep things short and to the point, I can focus on a few areas of multifamily real estate. A lot of these areas are going to be common knowledge for a lot of you on the panel. And, there are reasons why I personally prefer multifamily real estate and why I'm top heavy in my portfolio. So the majority of my capital and the majority of my assets are heavily weighted towards multifamily real estate, and a lower portion is for stocks and mutual funds. But, one of the things that I like about multifamily real estate is the fact that it's lower risk, it's higher returns, and it's very dependable asset to be involved in. There's strong, consistent demand with multifamily real estate. And, right now we're in a world where there's so much confusion on where to invest your money. There's so much volatility out there. So everybody needs shelter in good times and bad. So I think one of the, one pro for multifamily real estate is that you're basically investing in an essential need. Whether we like it or not, we live in a rental nation in this country. And there are so many individuals in this country who rely heavily on rentals. And so that, that makes, multifamily assets very appealing for investors. And I think that's one, very, very big pro in my checkbox for multifamily real estate. As a matter of fact, I was reading something the other day on some stats, and 43 million renters in the US. There are 43 million renters in the United States, and 37% of them are living in apartments. So I got that fact from Resident Demographics, the 2020 edition. So this basically means that almost 8% of Americans are dependent on rental properties just to survive alone. And that's created a lot of demand in the rental market nationwide. Cap rate compression has been remarkable recently, and that's why values have been explosive. When I speak to a lot of investors with my syndications as well, there's two things that we talk about all the time: cash flow and emotion. The volatility of the stock market right now makes no sense to the average investor. It really doesn't. Information is being supplied on social media. It's all over the news right now. And as we can see, especially during COVID, the stock market's moving just based on emotional aspects. So there's a lot of volatility based on emotion. Now, conversely, multifamily real estate performance is based on supply, demand, and cash flow. It's objective, it's steady, and it's a safer investment for an investor who really doesn't understand the fundamentals of the stock market. It's less risk, it's easier to understand, it's brick and mortar at the end of the day. So that's another big reason why multifamily real estate is a pro in many people's mind as well. And at the end of the day, we're all worried about the ups and downs of the market cycles and whatnot as well. And I think that multifamily real estate is as recession-proof as it gets. If you're in the right asset class, it can pretty much weather any storm. So, nothing's guaranteed, nothing's truly recession-proof, but it's as recession-proof as it gets. And again, you're talking about COVID-19. You still had in certain markets almost 90% of apartment buildings, you had people still paying rent. And it was a very big reason why values remained high. Occupancy levels were strong in many markets, and cap rates still remained low to support all this as well. One of the biggest things I get again, for another big pro with the multifamily market is tax advantages and benefits. And I'm taking advantage of that right now as the multifamily syndicator with cost segregation analysis. So cost segregation, just basically reclassifies components and improvements of your commercial building. So it allows you to basically take assets and depreciate them over, 1, 3, 5, 7 years, versus a traditional 27.5-year schedule. This basic, your current taxable income will be greatly reduced, and your cash flow will increase. That affects everyone differently, of course, but people like myself or any investors who are true real estate professionals, it helps us out exponentially at the year end when you're doing your taxes. So that's another big, big reason why multifamily real estate is a big pro in my mind. And Gaspar and I were talking about this earlier as well. Most people look at the stock market favorably over real estate because of the liquidity. So if you own, XYZ Corporation and you see some news that indicates we're going for an economic crash or the company's not going to do well, you have the ability based on liquidity to pull your money out of that particular corporation right away. Unlike real estate, which is non-liquid, but we're seeing a lot of assets right now. And Marco has a bunch, and Joseph as well, and a lot of us out there where, we're refinancing some of these deals within 2-3 years. So even though they're non-liquid, 1 year, right, Marco, exactly, or two in 1 year, correct? And I'm happy to be a part of those deals as an LP. But with that being said, there's a lot of deals out there in the multifamily world where you're not holding on to these assets, or I'm sorry, where you're able to refinance within 1, 2, 3 years versus that 5, 7, 10-year hold. So even though multifamily is not as liquid as stocks, there are still some short-term benefits as well. And leverage. That's pretty much how I'm going to end this off. Leverage right now. I think that, with stocks, if $100,000 of XYZ company gets you X, while a multifamily asset, you can put a percentage of capital down on the value of your asset, and leverage your money appropriately. So a lot of people look at the multifamily asset arena as something where they can leverage and take that $100,000 and purchase an asset that has much more value at the end of the day. And as the appreciation kicks in and as you amortize loans, you are able to create more equity short and long term. And those are some other advantages as well. We can go on and on and on about a few other things, but I'd love to hand the baton to my good friend Gaspar and see what he has to say about the stock market. But those are some of my takes on why multifamily real estate are the right choices for me and maybe the right choices for others as well.
Thank you very much, Robert. Those are all great points. And now we have Gaspar. Again, Gaspar, it's been in both stocks and real estate. So I want to hear from you as to what benefits are for stocks out there.
So first off, Joseph and Joe, thank you for hosting and having welcomed me into your home, so to speak. Robert, thank you for the kind words. You're a beautiful man. He's been a great partner, a great friend. Robert's, you can always go to him and you can always count on him. He's a wonderful person and a human being. Having said that, now I'm going to defend my industry. So, so the first thing is this. I don't look at the stock market where we're kind of looking at two different angles. Everyone here in this chat right now is a professional real estate investor in the market, where in the stock market, it truly allows you to be a passive investor, right? Unless you're looking to become a day trader, or you're looking to really focus and you're going to, you're looking to be the next Warren Buffett and you're going to, read the book, Intelligent Investor and all that other stuff, which is almost impossible to read, right? I'm in the industry, I tried twice. It's so damn boring and it'll put you to sleep. But besides that, it's different where Here are some perks in the stock market. First off, you truly can be passive. With ETFs and mutual funds and stuff like that, you can pick a fund where if I want to invest in real estate, I can through REITs. Through that, I will capitalize on the tax advantages through the REITs. So if all of a sudden I want to do multifamilies in the Southwest, I can find a REIT that focuses heavily on that. If I want to do warehouses because I think everyone's looking to open up a marijuana factory, I can do that. If I want to play it safe and just buy Clorox, which seems to be, and Lysol, which still seems to be impossible to get, I can do that. With that, some of the other points are regarding with leverage. First off, if you work a W-2, and let's just say whether you're a bus driver, whether you're an attorney, or whether you're a banker, whatever it is, a lot of companies offer a 401k match. So up to a certain point. So with that, day one, if I put 10 grand into my 401k, my employer matches 10 grand. Day one, I doubled my money. I got 100% return. If I just put it into cash, I doubled my money. If I put it into the safest bet, I doubled my money. Some other benefits are where it's pre-tax dollars. So it's sort of leveraged in that aspect. And then when you retire and you're getting that money out, hopefully you're taxed at a lower bracket. So you capitalize on that. So you basically arb in that play on the tax. Some other aspects are if you do want to trade where you are buying stocks, you can leverage more than just one-to-one, where if you're buying options, you can do that. You can actually leverage down your position by reinvesting dividends. So let's say if you're looking at a utility, because the price does not swing much, but it pays a really good dividend. So you're looking for a value in that aspect where it's cash flow. So you're able to average down your cost by reinvesting dividends. So the whole thing where I think the stock market is really great for our country is that it allows you to be truly passive. You don't really have to do a lot of research. If you believe in the economy, and you could do that, right? Warren Buffett says, I don't care what stock picker, I don't care what hedge fund, no one outcompetes the S&P 500 with all their fees. They don't justify their jobs. It's as simple as that. Now you might get a guy who has a great run, 3 years, 4 years, but in the long term, they're going to lose. Maybe not lose, they're just not going to do as well as the market, the S&P 500. So you can truly be passive in that aspect. Now on the same token, why do I like real estate? I like to diversify. I don't think there's one tool for everything, right? I was saying before where if my favorite tool is a hammer, you cannot build a house with just a hammer. As great as it is, and as fun as it is, you can't build a house with just a hammer. So you need different tools. There's also other things where it could be a whole life insurance. You can argue that whether it's a good investment or not. But it has a specific purpose. So what might not work for you, Joseph, works for Joe. What works for Joe may not work for Robert, may work for me. So everything's different. And that's why there's something called investments. If there was only one great investment, there would be no competition. Everyone would just invest in that, and that's it. It's simple as it is. Regarding what Robert was saying before with safer, I don't necessarily feel that multifamily is safer, so to speak, because there is something called foreclosures, right? So leverage, in my mind and in my choices, my whole thing is real estate is safe when I have staying power. When something, a force of nature takes the staying power away from me, I no longer have control. And that's when I could lose, right? If someone can dictate when I have to sell, chances are it's not going to be at an advantageous price. I'm going to take a bloodbath on that. So the whole thing with leverage is you want to make sure you have staying power, and especially in real estate. And in the stock market, you don't want to get a margin call, and it's the same thing in real estate. You don't want to have something where you bought it and you put just enough money down where the rental that comes in pays every expense to the penny, and there's nothing coming in above that, and you're just waiting for appreciation of time. right? Inflation. Because if something goes wrong and your tenants don't pay or they close up or whatever happens, you're gonna have a big problem. So in that aspect, so multifamily, I think, is safer, right? But it's not safe. I do like multifamily. I also like it a lot more now on a larger scale. So for a typical landlord, where they're gonna do like a house hack or something like that, you're the boots on the ground. When there's a leak, you're getting the phone call. When the person's not collecting the rent, you gotta go knock on the door. You gotta go to the magistrate. You gotta figure out what do you have to do. So I've been a landlord for many years. As a child in my family, we've had multifamily, and I grew up to realize I hate being a landlord, but I love real estate. And that's why myself and Robert have teamed up, and we're looking to do larger things. So we don't have to be the landlord. We can be the asset manager as opposed to the landlord, which is different. In that aspect, if you're having some troubles, you can always raise some more capital. Also, because of the expertise, we're able to implement plans such as the value add, where you're just not buying an A-class property and you're collecting that check as like a bond, so to speak. So there is wiggle room, and you are creating passive income, and you're adding value. You're forcing appreciation. So I think every asset has its purpose. For me, stocks have a major reason in existence. Obviously, it's built the backbone of this country. It allows corporations to be what they are. If there wasn't a stock market, we wouldn't have Tesla, we wouldn't have Apple, we wouldn't have GM, we wouldn't have all the great companies that America knows. So that is something to be had there. But as Robert said before, every tool is different and it has a certain purpose. So I don't know where I am with time, but it's basically, I do believe stocks have value and is a reason. And it's simple as where you don't want to have a second job, where I'm not looking to start doing, I mean, it takes a tremendous amount of research and time to do real estate in a market. You need to know, you have to become an expert in that location. Now, granted, with the internet, it's become a lot easier, and Google Maps and all this other stuff and all the data. We have data up to our eyes. So that's helped. But if you're looking to just like, you know what, I come home, I'm tired, I want to play with my kids, I want to relax, so I'm looking to, I'm single, I want to go out and party it up or whatever it is. You're able to invest in the long term, and everything is a long term, especially with stocks. So that's the whole thing. If you have the faith in the country where it's going in the long run, then it's great. But as Robert said before, you do want to start scaling back as you get older, right? You don't want to be 80 years old and 100% in stocks, and then you have like another Lehman Brothers episode or something like that. That's a tragedy. But really, that's it. So if anyone has any questions.
Mm-hmm. Great. Thank you very much, Gaspar. I really like the fact that you said, one way or the other, it's just one tool out of the toolbox and out of the many tools, and you leverage all. From your perspective, as you're supporting the stuff here, I know you're investing in both, but for the sake of being today as a guest, what will be the cons from your own perspective of the stocks?
Cons of the stock. Okay. Emotion. Robert mentioned that before, where it's kind of funny. He said, where, while you were saying, I'm picturing the guy comes home, he puts on the TV, it's, Eyewitness News or whatever. And, the CEO of McDonald's is making inappropriate gestures to one of the employees or whatever. If you're going to sell the next morning, you're too late. Okay. So don't sell. You're way too late. So that's called the odd lot theory. So because the big companies with the money and the professionals, they're buying large shares. They're buying 10,000 shares, 50,000 shares, 100,000 shares. Odd lot are the people who come home and say, oh, you know what? Let's buy 3 shares of XYZ. So that's an odd lot as opposed to 100 shares, which is a round lot. So that's the odd lot theory. So there's a whole cycle on that where you would see a bunch of odd lots trading. You would say, okay, now's the time to buy because the suckers are selling. So it's kind of too late. So at that point, so if you come home and you see something on the news, it's too late. So if there's like a Tesla car crash or something like that, Do not sell your stock on that news. Unless you get it on your phone quickly, don't sell. So that is one of the cons where you're always kind of late, right? You're not gonna beat the professionals in that game, in that aspect. That's one con. Another con is you don't have control, right? If I buy ABC stock and I think the company's doing something foolish, the only option I really have is to sell, right? I can't call them and say, what do you have in your mind? Why are you pulling out of this market, or why are you doing this, or why are you doing that? You can't do that. So there's no control in that. The other thing is where it could be a scam, right? Or if something's going on where it's a pump and dump. Perfect example in this whole Reddit, right? Wall Street bets. Totally chaos, total chaos with the whole GameStop and all that. And if you got involved in that, hopefully you got in, out on the right wave. Because if you got out on the wrong wave, we got a problem, and not that Bitcoin is a stock, but it's because it's tradable in that aspect and it's so easily accessible. It's become like it's almost like the currency of the foreign exchange currency, which kind of died out, especially with Europe going to the euro. These guys are leveraged 100 to 1. So your margin calls on that are you got to be next to your phone because you got to constantly getting margin calls with the swings. So in that aspect, the fees can be high, although technology's done away with that. So those are kind of like the cons with stocks, I would say.
Thank you. Very interesting point. Thank you very much. We have couple of questions. Let me read it. You know what? How about Nico? You just unmute yourself and speak up.
Hey guys, thanks for doing this. This is awesome. All right, so both of you, I guess, today, like not a few years ago, let's say today, what percentage of your portfolio is in stocks and what percentage is in real estate?
Great question, Nico. And again, I think it comes down to everyone's personal choices. But for me, for example, I've been following the 80-20 rule. So 80% is real estate, 20% is stocks. And within my 80% real estate, I'm even further diversified with smaller multifamily deals, mid-size syndications. And again, I think I've said this earlier, but GP, LP, NKP, and hybrid. So I try to diversify within diversifying, but I follow the 80-20 rule for me personally. But that's just a personal choice because I'm more hyper focused on real estate versus stocks.
Before Gaspare, you answer, Robert, can you just also share, I guess, how much time is spent? Is it like, do you spend 80% of your time on real estate and 20% of your time on stocks as well, or is that different?
Yeah, I remember that 80-20 rule has been in my head since I started in corporate America in 1996. And I remember my boss, when I was in the hotel industry, she said, 80% of your, 20% of your, I'm sorry, my head just twisted a bit here. 80% of your business will come from 20% of your customers. So good question, Nico, because you really have to focus on, what produces the most, for you. I'm in that 80% allocation. I do spend almost 90% of my time on multifamily real estate. And when I have some free time during the week, I'll look into new corporations for the stock market. I also have a financial planner that helps me out. But I say this all the time, I'm just trying to work smart, not necessarily as hard as I've used to in the past. So, that's how I personally do things.
Awesome. Thank you, Robert. Gaspare?
There we go. So regarding myself, I would say I would probably be 80-20 stocks, 20% real estate. And it's probably a little bit more even recently because I have a trust that my family trusts, and that's real estate. So obviously that bumped it up a lot. And the reason why trust not being part of the equation is because I've been working so long. So a lot of my money every year goes into my 401k. I also have, like I mentioned before, I also have a whole life policy, right? Which I wouldn't recommend that as a 100% investment, but it's just another tool. There's 529s for my kids. So I do try to take advantage of all the tax benefits and stuff like that these plans have. But I do like real estate. I love real estate for the long term. And I do love it for when I love cash flow. And I see cash flow through real estate. I really don't see cash flow through the stock market, to be honest, even though obviously you can, right? But I like to see the pot, and I like to see the dividends coming down and me not touch the pot. So if I have $1 million, I don't want to retire at 65 and then watch my million go to 980, to 920, to 870, and it continues to go down. So my biggest fear is I'll outlive my 401k, right? So I don't want to be homeless at 95 years old. So I do love the cash flow aspect. So to answer your a little bit long-winded, Nico, but I'm 80-20 stocks, and the reason being is because I've been working for so long for corporate America. If I would have started a lot earlier into real estate, it would obviously be a lot less. Amanda wrote a quote. She wrote, okay, I thought she wrote it to me. You are correct. They do charge a lot of fees. That's why I mentioned before where Warren Buffett said, rather than pay fees, just buy an ETF. It's like an S&P 500. The fees are very minimal there because it's not rocket science, right? Everything's laid out. You didn't do anything that was so great. The formula says you need to have this many shares of A, this many shares of B, this many shares of C, and everyone does it. So whether it's Franklin Templeton or Prudential or whoever it may be, your favorite, fund, it's a strict formula. It's not rocket science. You cannot demand a high premium for that because you're not adding any value. So that's how it is. So and that's why Warren Buffett said, don't pay those fees, just buy the S&P 500. So in that aspect is where I say you can just be passive, where you say, you know what, I can allocate $100 a month into this, and every month you're just buying the S&P 500 wherever it's trading at, and at the end of the year you have an average. So if that answers your question.
Thank
It
you.
does. Thank you.
Okay. Hey, Gaspar, just piggyback on it. You just mentioned you prefer when it comes to cash flow, you prefer cash flow over dividend. Was that what you said? Over stock?
I love cash flow. Being an old school Italian, you never want to dip into the pot, right? You always want to be, you don't kill the tree, you pick the fruit. So the whole thing is I don't want to kill the portfolio to eat. So with real estate, I can see that because what happens is you buy it over time, you pay a mortgage, the rents continue to go up, the expenses go up. But if the rent is higher than the expenses, even on a proportion level, if it goes up 10%, you're going to be making more and more and more. And then once the mortgage is done, because the mortgage is fixed in a traditional 30-year or 15-year conventional loan, now you're really making some decent money. So you don't have to basically chop down the tree or kill the chicken and still enjoy your eggs.
Right.
So my whole thing is I like real estate for the cash flow a lot more than I like the stock market.
Well, people say you get dividend from stock market. What would you say to that?
Well, you do. And the whole thing is, but with that, the flip side is you don't get much value. So your stock pretty much stays the same. So if you bought, right, being in New York, if you bought Con Ed or whatever the hell the electric company is now there. So your stock may be $35 and in 10 years, it's now $42. Where if I bought Tesla, it might be zero, or it might be 4,000 with 30-to-1 split twice in 10 years. So you're giving up the appreciation, right? There's no growth in that stock. But you don't care, right? Because at that point, you should be buying those utilities in the high dividend stocks, whether it's Coca-Cola or Clorox or whatever it may be, where it's not so much the swings, it's the cash flow, it's the dividend that you're interested in. I need it to pay for my Mercedes. I don't need it to go buy a yacht 20 years from now. I'm 80 years old. I don't care about that.
Gotcha.
That's where the stocks would help out. So I agree. But in that aspect, I would still rather have real estate than a dividend portfolio.
Okay, thank you. Jay has a question. Jay, would you unmute yourself and ask the question?
Yeah, thank you guys. Thank you, Joseph, Joe, set this up and awesome. Thank you, Robert and Gaspar. I'm in Seattle, Washington, with a lot of tech companies here. A lot of my buddies are working on Microsoft, Amazon. They're getting compensated as a stock from their own work. They've been seeing what I'm doing and investing in multifamily and then getting knowledge. I want to be knowledgeable as possible. So if they have any question and they wanted to invest in a multifamily, how do they reallocate their money from stock to multifamily without getting charged too much on the capital gain tax when they sell, which they are in the high percentage bracket. So I look up the Google, it's the only few ways to avoid the capital gain taxes: lose your job or give to your stock. So I don't think that's an option for them. So I like to hear that from you, from your expertise, also from Robert too. I'll appreciate it.
So
Well, I will, real quick, and then you could jump in on this. It really depends on where their stock is, right? If it's in their 401k, and Robert could attest to this because we have an investor who actually sold stock, put it into a managed 401k where they're actually managing it. And it's basically like a glorified bank account. So, and they have stocks in there. And then they sell the stocks and now they have cash in there. And from that cash, they can invest it as long as they're not actively managing it. So they can't sell the stock and then go buy a business. They can't buy a 2-family house, but they can be a investor in a syndication. So, and Robert and I know someone who's doing that with our one deal. That's number one. If it's not in that, it could also be restricted where they're not able to sell stock for X amount of years. So they may have, 20,000 shares of Amazon, but they can only sell 2,000 shares a year or 5,000 shares a year or whatever it is. So they're restricted.
Mhm.
And like you mentioned before about getting fired, the company does frown upon that because it doesn't show much confidence in the stock, in the company. So it can be difficult. Taxes, if it's in a 401k, you can do that and roll it and keep it in the 401k. But if it's your own personal stock, you got to pay the piper. There's no ifs, ands, or buts about it. Perhaps if you have a slick tax advisor, perhaps what you could do is take the money, get leverage on the money, like basically use it as collateral. I know a lot of executives do that. So like Elon Musk, he's not cash rich, he's stock rich. And before he said, I'm selling all my homes, he was supporting his lifestyle through the leverage of the stock of the company. So he would say, I got, $800 million worth of stock. Somebody give me $10 million, I'm not going to have a party. So they can do that. So you're now technically selling the stock, you're borrowing on it, you're going to be paying a fee, a VIG, an interest rate, whatever you want to call it. But now you have cash, and you could take that cash and then buy property. So if you're paying 4% on the cash on the stock, and you're able to invest it into a multifamily that's going to give you 10, 12%. So now you just tripled your money on that and you still own the stock. Now the caveat to that is if they give you, let's just say 30 cents on the dollar and you have $10 million, if it dips below 3 million, you're going to get a cash fall, right?
Yep.
So then you got to come up with some money. So Robert, go ahead, I'm sorry.
no, well done, very thorough. Not much to add to it other than probably one point. I constantly get investors who are inquiring about whether or not they can offset capital gains on stocks with cost segregation strategies for multifamily real estate. And the answer is no. So as Gaspar mentioned, you just have to pay the piper on your short or long-term capital gains for the stock market. Again, and I mentioned it earlier, real estate professionals who are involved in real estate full-time have heavy favorable tax advantages with cost segregation strategies. And people like Gaspare who have W-2 job in the industry, or anyone who has a W-2 job in the industry and also has assets that are producing passive income, that's where you can take, your cost segregation strategies will assist you with the passive income. But the capital gains, unfortunately, have to pay the Pied Piper. So I wanted to add that because we've been getting that question a lot. And I think, Jay, you were alluding to it because you have a lot of people who are also looking at the stock market right now with peak values on certain stocks. They're ready to pull out. And where's your money going to go next? Right. So we constantly have Zoom calls and in-person meetings with a lot of people in Gaspar's field who are looking to maybe swing that 20-80 like Gaspare. Let's get it more to 50-50 minimum, right? But a lot of them now are swinging the percentage of equity they have in stocks to real estate and maybe trying to leverage it out more to 50-50 or 60-40, something of that nature. And you made a good point before, Gaspare. It's not that real estate is 100% safe. It's safer in some investors' mindset for the many different reasons. It's shelter. Some of these workhorse assets, especially in B class, can weather many storms. If you own an asset with 100 units, even if you get hit over the head with 20% vacancy, you still have revenue coming in. You're still amortizing a loan. There's still revenue coming in. If a company goes under, it's gone. So there's a lot of different reasons. We can go back and forth in this battle on stocks versus real estate, but there's a lot of pros for both of them. And that's why a lot of people are, simply diversified accordingly. So.
Thank you, guys.
Yep.
Thank you. Joe?
Me?
Yeah, thanks, guys.
All right.
Sorry. No,
Actually,
sorry.
no, Michael, go ahead.
No, I went under my deck. Go ahead. Sorry. Go.
Joe Sullivan. Let's go.
Yeah. Okay. So my question was, if you guys could help me, and hope I imagine others have questions about this, is about a REIT versus an LP position and a syndication. Pros and cons of each. I struggle with it, so I'm sure others do as well.
Well, I guess I'll discuss the REIT, and Robert, you can discuss the syndication LP part. So the truth of the matter is this: the internet has helped this field grow tremendous, right? So I remember when I was younger in the 80s or whatever, and I would try to convince my father to push the envelope. Like I love the action, all right? I'd rather be in the game and trying to figure out how to make it work than out of the game and looking from the outside. So, and I used to tell my phone, like, listen, Dad, why don't we buy this? Why don't we do that? Or whatever. He's like, you can't do that. He's in the time, he's off the boat, this and that. And he's like, you can't buy these. These are corporations. You can't deal with this. These are corporations. You can't deal with these. So with that, the internet has made syndication and investing, like group investing, a lot more accessible and more well known. So before that, you had REITs, where it's basically all of these high-end professional companies, whether it's the Blackstones or or whoever it may be, not to name anybody, or I did say Blackstone, but anyway. So you're able to now pick an industry. You could pick a general, where it's commercial real estate. I can go and say, you know what? I think that the real estate market in Kenya is going to explode. And I could pick a reputable company that has a global presence and a certain fund that whenever they have a fund, they have to allocate. They have to tell you what it is, right? I can't put 100 grand into a Kenyan multifamily fund and then find out these guys are buying UPS stores in Hackensack, right? You can't do that. You said the allocation was going to be for multifamilies in Kenya. What the hell is a UPS store in Hackensack have to do with this? So it's allocated towards that. Now, vice versa, if you were an investor, you're like, Kenny's gonna explode. I want to go buy multifamily house. You're gonna send money to some guy that's a real estate syndicator in Kenya. You're gonna send him 100 grand and say, yeah, I want to in on this deal as an LP. I mean, I wouldn't. And if anyone here would, let me know who you are. And if they contact you, just give me a heads up first. I'll save you some money because it's not going to work. So with the REIT, you're able to get a real investment and you can pick that industry. So now with syndications, with the internet, you're able to do that a lot easier than in the past. But you can't compare with the REIT. So.
Robert?
Well, again, well said, Gaspar. And, I know a lot of people have this debate back and forth with REITs and LPs as well. But another pro for the stock market is that REITs are also liquid. So, you just can't compete. If your investment strategy does not allow you to hold your money, in someone else's possession for that 1, 2, 3, 4, 5 year cycle, then REITs is a way to go because it's liquid. But on the flip side of that, and this is something that, Gaspar's in the industry, so he's constantly surrounded by investors who are also in the finance field, and myself as well. We're part of these groups where we have these conversations all of the time. And some of our financial minded friends who are in the Wall Street market as well, they're always asking us about the true definition of how an LP works. It's another battle in itself, right, Gaspar? You have a lot of thick-minded individuals who are only looking at the stock market one way and real estate a different way. But again, with the LP, you're able to invest truly passively, get strong returns. If you find the right sponsor who is an expert, who is very, very experienced, and they're driving the battleship into any wave, you can do extremely well passively. So, I truly believe in the LP model. Proof is in the pudding for me. I put, my money where my mouth is. I'm doing it myself now because of the truly passive aspect of it, where my returns are strong, short-term and long-term. And when you're dealing with guys like Marco and Chris Jackson, who have these incredible deals where they're refinancing within 2-3 years as well, that is just the ultimate leverage, and your returns can be infinite as an LP. And that's why IRRs are through the roof. You get your money back quicker, you put it into other deals, and you keep leveraging, and you're doing it all passively. It's just a beautiful way to invest your money from an LP perspective. So.
And Robert, to add a token, a feather into Robert's cap, as an LP, you do get those tax benefits that Robert has mentioned a few times directly. I also like to think where if you don't understand something, you can call the GP and say, so I don't get this. What's going on? Why did we do this? This doesn't make sense to me. And you can get an answer, as opposed to if it's a REIT, who are you going to call, the stockbroker?
Yeah.
They're not really going to know unless you're a tremendous investor and you own a big piece and you get those, what's called corporate access, and you get to speak to the company and CFO directly. You're not going to have that audience. So that is another perk for an LP.
Guys, that was really helpful. I think Robert, to your point on the lack of liquidity with the LP stake versus the REIT, I think that's probably, for me early on, that's my biggest hang up, is just lack of access to my capital. And the REIT, you have that. So everything else I like about the LP spot in the syndication. So thanks for comparing, guys.
Yeah, no, absolutely. It's a
Thank
tough
you.
one for people to overcome, the lack of control with your money from a liquid perspective. But you see more real estate deals now where you're exiting, your capital is being implemented back to you. The velocity of that capital is coming back quicker in a lot of these deals now. So those are maybe deals, if you do have a fear of not having money back for years, maybe you try to look for sponsors who are able to offer that in deals as well. That's another way to, maybe meet in the middle, so to speak.
Thank you. Thank you for both. Just a quick follow question for both of you. So there's no depreciation for each investor for REITs. Is that correct?
Direct, no, they get it and you profit from it indirectly as being a shareholder, right? So you're basically an owner. So as they depreciate, their typewriter, whatever it may be, you receive that because there's higher cash, liquid cash at the end, real cash. So you get that benefit as a shareholder, but not you personally, where you write that off on your tax.
Right. So if you are a real estate professional status, you cannot use REITs depreciation directly to offset your active income because you're just going to get higher return from the REITs, right?
You can write, if you have a loss, you can write that off up to X years, like it's 5 years or whatever it is, on profits on other stock investments.
Other stock investments, but not other rental incomes.
I don't know. I mean, I don't know. I mean, if you talk to your accountant, he'll be able to answer yes or no. And I guess if you call enough accountants, you'll find the guy who says yes. So I don't know, to be honest.
That's fine. Okay, thank you. Thank you very much.
Yosef, I don't know if you want, there are chat. I don't know if you want to read them or whatever. So everyone hears it.
Yeah, we have a few more. Amanda was answered, right? And Mike.
Yeah, so quick question. So I know that, when I was in college, I understand real estate, but like I wasn't, really familiar with it. I understood a little bit about stocks. What advice would you give to let's say a college kid coming out of college and he wants to either get involved with stocks or real estate? I mean, as both professionals with you two, would you recommend he or she to get in more into real estate, more into stocks, or would you consider the 80-20 split as a young potential investor?
Great question. And, again, I think it comes down to your individual situation as well. I mean, what's extremely important? What type of an appetite do you have for risk? Things of that nature. Gaspare could attest to this. I remember when I was in my early 20s, my investment outlook was very different than what it is now in my late 40s. So, everything was all about aggressive stocks, right, Gaspare, and your 401k plans and everything. So I definitely think that someone out of college at 22 years old should have investments in the stock market, and they should be aggressive if they're in it for the long term. But real estate's tough. A lot of people, have that fear of the brick and mortar as well. So I don't know. I really don't know how to answer that accurately on, I would have to speak to each individual, understand their position, understand their career paths, understand their capital on hand. So in my opinion, it would be an individual conversation with each investor, and then you tailor your response and strategic plan to that individual. So I don't think there's a standard rule per se. As I've mentioned several times, that's just the way I think. I think every individual is different. So it has to be catered towards your individual situation at the time. But when I was very young, in my 20s, before I was married with children, I was very, very heavy into stocks and real estate, more 50-50, quite honestly. And then I started to go like this with the stocks. And that's where I am now. And I know Gaspar's here, but I'm trying to convince him to be at least here and maybe here soon, right, Gaspare? So.
Robert, that was brilliant, to be honest, the way you phrased that. And it actually, when you were saying that, it gave me ideas. The whole thing is this, Michael, it all depends, like Robert said, on the individual, right? So, and I'll be honest, whether I'm a syndicator or if I was a financial advisor, right? If you're coming out of college and you don't have a job, you have school debt and all this other stuff, as a syndicator, I would not take their $25,000 to invest in. It's just not happening, right? That's number one. Number two, even as if a financial planner, I would first turn around and say, listen, get yourself out of the hole. Okay. One of my favorite things I wish I would have done younger was I wish I would have done more, and my father actually did it before it was even called a technique, was the house hack, right? My father house hacked before it was even called a house hack. And he basically told me, he goes, listen, he goes, single family homes are for the rich. He goes, like, we buy 2-family houses, 6-family houses, and you live in them and you collect the rents. But Mike, if you're in, you know, some of these guys are saying in Silicon Valley and you're working for a tech company, number one, can you afford a 2-family house or a 4-family house in those areas? That's number one. Number two, if you do, what if in 5 years you get an opportunity to work at some startup that's gonna, you know, it could be a grand slam if it works out. Now, what are you gonna do with this 2-family house? I'm pretty sure in that situation, you're gonna be leveraged to your eyes. You're not gonna be able to afford a property manager to come in. So how are you gonna manage it? And if you have to sell, my luck, chances are, if I'm forced to sell, what did I say before? It's at the worst possible situation. So chances are you're gonna have to take a beating for that other chance. Whereas if you invested in stocks, you could just say, yeah, no problem. So I bank, you know, I broke with Merrill Lynch. I can do Merrill in Texas. I can do Merrill in Wyoming. It doesn't matter. So it really depends on that person. Or you might come out of college and you're looking to start a business and be an entrepreneur. At that point, I would say don't invest in stocks. Don't invest in real estate. Invest in yourself and build your business. So it really comes down to, as Robert said, who you are and what you're looking to do. But I do love house hacking. So if you could do that, that is phenomenal. You get some sick interest rates, and if you're in the military and this and that, and you just start exploding. That's a phenomenal move right there.
Thanks, guys. I appreciate that.
Great. Thank you very much for both of your answers. It was great. Last question we had is from Chad.
Yeah, I'll ask it here. Gaspare, first of all, I wanted to congratulate you for getting through the Intelligent Investor twice. I took about 3 months to get through it once, and then I needed a month off because my brain was burnt out. So if you did get through it twice, congratulations.
No, I didn't get through it twice.
Oh,
I did it twice.
gotcha.
I just couldn't. So go ahead, Chad. What's your question?
The method that you were describing earlier regarding leveraging your stocks against the loans, I thought that was a loan management account. Is that the correct terminology?
I'll be honest. I don't have those problems. I don't have, 2 million shares of IBM. So I really don't know. That's kind of more on the senior executive level. So I don't know the terminology, but I do know that is how the CEOs, CFOs, COOs support their lifestyle, right? Because they're locked up with a lot of stock, and the company and the people themselves really don't want them to sell. As a matter of fact, I met one guy. Our kids were playing sports together. His whole job was to talk to CEOs and plan for the year how they were going to divest a portion of their stocks. So they have to put it basically in writing and say, we can't sell it here and we can't sell it here because of earnings, right? We can't sell it, X amount of days before earnings, X amount of days after earnings. So we have this window to sell stock. When can we sell it? And then this way, if something hits the news and all of a sudden they say, CEO sells 50,000 shares of this stock, $30 million worth of this stock. And the next day something hits on the tape where it's extremely negative. They're not going to jail. It's like, this was in the works a year ago. How the hell did I know that such and such was going on? So I don't know the term, whether it's LMA or something else. The one where they plan it, the name slips me. But like I said, if you're on that level, that's a good problem to have. What to do with your 300,000 shares of IBM or whatever it is. So.
Thank you. No, I appreciate that.
Thank you very much. So yeah, I think this was great discussion. pros and cons of both stocks and multifamily investing. Myself as a multifamily investor, obviously that's more for me, but today we all saw that this is not just black and white. You know, each individual, they have their own preference and they have their own goals and visions, and you can actually compare those two and, you know, just pick what's better for you. And for myself, it was multifamily investing, and for someone else might be different. And Marco, you want to add anything to this?
Yeah, I mean, I gotta say, Gaspar, you did a great job. It was really nice to meet you, and Robert, I expected nonetheless. But I want to actually, I think I could add a little value to summarize everything they said. I mean, I think the biggest word, if you want to write down, is diversification that Kiyosaki talks about. So I started out with a 4-family when I was 23, but I was heavy in stocks because it was easier for me to invest in stocks than to find the property because I wasn't educated in multifamily. So now there's a few things they talked about. I'm diversified. Everybody should write this down. You need to learn everything besides your job. I have a whole life policy. I have a $2 million whole life policy that have $400,000 of cash value in. I use that cash value to buy multifamily, and I'm getting 5% on it. And I have a $2 million death benefit for my kids. Okay, it's actually up to 2.6 now, or 2.5, because it keeps getting dividends. I have a few mutual funds, Vanguard. I have a couple. I used to have a lot of them in 2000. I'm very low in stocks now, guys, because I own 30 properties. I have some stocks. I just don't like stocks anymore because of Enron, GameStop, WorldCom. But I made a lot of money with stocks when I was younger. It's an easy barrier of entry. You know, crypto. Everybody here, it's the next disruptor. It's already disrupting. You need to learn about crypto. We have a crypto chat in the mastermind. It's just like stocks. I made $100,000 in crypto, guys, in 3 months. What I do with that $100,000? I'm going to pay tax on it, right? $30,000. I put it into a property with me, Chris, and Joe. I'm going to get cost segregation on it. I'm not paying taxes on it. The cost segregation, because I'm a real estate professional, is going to wipe out those gains. So what do? Make money in stocks, put the gains into multifamily, get the tax benefits. If you're not a real estate professional, you still get some. That's crypto. The printing press was a disruptor. The internet was a disruptor. The cell phone was a disruptor. Cryptocurrencies are disruptors now, just like the stocks. So you should learn. Multifamily. So multifamily leads to financial freedom. But if you're a beginner, it doesn't mean run out tomorrow and go try and buy a 4-family. You need to get educated. It is the best space, the most competitive space. So you need to get educated. You just don't jump into it, because you buy a bad deal, you're done. Okay. So the stocks that he's talking about, it's all excellent. It's probably the easiest barrier of entry. One of my friends, he has a $200 million stock portfolio that he runs his company for people. His company's worth $20 million. He's going to sell probably $5 million worth of his company. Where do you think he's putting that money? With me in multifamily, because he doesn't want to work anymore. So he is actually in one of our 44 unit deals with me, Joseph, and Joe Sullivan. He wants to invest with us. So even him, he is such a great stock investor. But you know what he said to me? He goes, I know multifamily is amazing. He's so busy at his job that he wants to do it on his own, but you can't do it on your own. But he found the right team to do it with. So now he's an LP, he's a GP, and he's in stocks. He loves stocks. So he's always going to do stocks, even when he's 70, because that's his thing. He likes to make money, but he's going to take those gains and try and put them into multifamily with us. He found a team. So it's a full diversification, just getting fully educated in every asset class, and even gold. Kiyosaki says buy gold, you know? So I think it's just an education. And there's no, like, people bash stocks are great. I mean, it's just being with the right person. It's like, if you're going to do stocks, you're going to do on your own. No, you want to do them with somebody like Gaspare. You know what I'm saying? Am I wrong or right, Gaspare?
So no, I think you hit it right on the head, right? Especially with the diversifying the portfolio. That's number one. It's a tremendous play to take the profits from one and roll it into another, right? So now you're getting twice the value. You're getting the tax incentives, number one, and you're getting the play on the diversification, number two.
Mm-hmm.
The easy barriers to entry was tremendous. I mean, to be quite honest, if you get a job tomorrow, wherever it may be, and they're offering you a 401k match. You got to be foolish not to take advantage, at the very least, up to that number. If they're willing
And
to-
you want to know once you build that 401k up, you want to know my opinion? We teach this. Flip into an EQRP or self-directed investment in real estate. And say I have people who have $500,000 in an IRA and they go, take it, Marco, take it all out and put multiple. I say, no, leave 250 in stocks. Let's take 250 out in a self-directed, which I don't like because it's UBIT tax, or put in a UQRP or whatever one, pull it out and put that into the multifamily, but always be diversified and leave some of the stocks because they find us and they're like, oh my God, I don't want it anymore. Like you said, no, there's nothing wrong with it. Put it into a good mutual fund or a good whatever you recommend. But guys, the main thing is diversification, because somebody tonight will hear like, oh, okay, Marco. So here's another thing, Joe, what made you quit your W-2?
Real estate.
There you go. I don't work. I'm financially free. What got me to here? Multifamily. But I did use stocks and gains in stocks to put into multifamily. So I mean, I think it's an overall education, guys. Whatever you pursue in life, stocks, crypto. My friend called me up. He's like, Marco, should I buy XLM? Somebody told me. I'm like, do you even know what the name of it is? He goes, no, but they told me to buy it. Go ahead. So we have a crypto chat. I have John Beatty on there. John Beatty is a professional oil and gas. He's telling me, Marco, he told me to buy Ether at 600. It went up to 4,000. I sold it actually at 2,400. So, I mean, when you do something, it's a thing, it's the 5 people you surround yourself with. Surround yourself with people that know the space. Okay. With people that do it with people that are educated and get the education, whether it's stocks, multifamily, everything. It's just, I think it's an overall, I think you should just overall diversification, education. And these guys covered it great tonight, like on both ends and the pros and cons.
Thank you. Thank you very much, Marco, for your insight. So Robert and Gaspar, if any one of our attendees or listeners, if they have a question or reach out to you, how can they do that? How can they reach out to you?
So I'll put my my website in the chat, and you can reach me there. You can subscribe, send me an email, whatever it is. Just remind me where we met, whatever. And if you have any questions, I'll always be honest and straightforward, and I'll tell you the truth, whether you like it or you want to hear it or not. But that's my opinion.
Of course you will, because you're Italian, Gaspar. So listen, I'd love to. I'm gonna get your info. I'd love to jump on Zoom with you and talk to you.
Awesome. Sounds good, Marco.
All right, and Robert.
Well, I am blessed to be connected to so many of you on the call. So I'm in the MIH group number 6. I'm on all the chats with most of you. But for anyone who is not in one of my groups, I'll just throw my email and phone on the board right now. So that everyone
Guys, get it. Whoever doesn't know Robert Musso, get on a Zoom call with him. He's got 4 deals in contract right now. He's diversified. He's very knowledgeable in many asset classes, like we talked about tonight. So somebody you definitely want to network with.
All right. Thank you everyone for joining tonight. And thank you, Gaspar and Robert and Marco for your insight. We learned a ton of good stuff today from both of you. Thank you again. And thank you for coming tonight. Thank you, my partner, Joe, and beautiful daughter with you today. All right, everyone. Have a great night.
Have a good night, guys.
Bye, everybody.
everyone.
Thank you.
Bye.
Bye, guys.